Welcome back to Investing Talk Podcast. Today, we are focusing all our energy on, well, one of the most volatile and intriguing small-cap stocks we've seen in months. It's a company sitting right at the intersection of private aviation and massive infrastructure development, Jet.AI. Our mission today, pretty simple, really. We're pulling together all the source material, the detailed stock analysis, recent corporate filings, market sentiment, everything we could find to answer the question you keep asking. Is Jet.AI a good time to buy now?
But before we jump into this rather complex story, just a quick reminder, please hit that subscribe button, like this content if you find our analysis valuable. And hey, if there's a specific company you want us to look into next time, just leave a comment below. We really do build these conversations around what you want to know.
That's right. And, to frame this conversation properly, we have to say right off the bat, this isn't your typical stock analysis. Jet.AI, it started out as an aviation tech company, right? But the whole story, the core narrative, it's completely fragmented now. The stock's seeing extremely high volatility, and that's precisely because the company is in the middle of this huge strategic pivot. They're basically trying to change their whole identity.
From logistics tech to...
No, what exactly?
To primarily an AI data center infrastructure provider. It's a massive shift. So yeah, we've really got to look at this stock through two different, almost contradictory lenses at the same time.
Okay, let's unpack that initial identity first. When Jet.AI first appeared, their main thing was being an AI-first innovator in private jet logistics. They weren't just another broker setting up flights. They were building their own booking solutions, trying to optimize the whole process. Exactly. The sources really highlight their tech. CharterGPT, Reroute AI, DynoFlight. And these aren't just, fancy names. They're algorithms designed for smarter, more efficient private jet operations. Things like optimizing empty legs, getting instant pricing. They genuinely tried to set themselves apart from the old school charter companies, really push that AI angle.
And they recently launched Ava, right? Their AI booking platform.
Yeah, reinforces that tech identity.
Okay, so that sounds like a pretty interesting, albeit niche logistics business. But if that was the plan, why the sudden really drastic strategic pivot? Are they just chasing the AI infrastructure hype, or is there something deeper going on?
Well, that's the core insight the sources point to. The thing about being a private aviation logistics provider, it's often a low multiple business, and it eats up capital.
Right. High operating costs, constant need for investment to grow.
Huge CapEx, exactly, especially if you want to grow fast in aviation logistics. So the pivot, it looks like a calculated move to, arbitrage capital. They're using their existing AI brand name, which they built up, to try and swap out of that low multiple logistics game and into the potentially high multiple, high margin world of GPU hosting and AI infrastructure.
So repositioning themselves almost overnight as a pure play tech utility, hoping the market gives them a much higher valuation.
That seems to be the play. It attracts a different kind of investor, different multiples.
That makes the ambition clear. Okay, so how are they actually funding this huge shift? We saw, I think, 3 key transactions mentioned that support this infrastructure strategy.
Yeah, the sources confirm they're making serious, tangible moves. First, on the signaling side, they authorized a share repurchase program back in August. Only $2 million, so relatively modest, but it signals management thinks the stock's undervalued.
Okay, a confidence signal. What else?
Second, and this is critical for actually doing it, they moved forward with a definitive agreement with Consensus Core Technologies. The plan is to jointly develop hyperscale data centers up in Canada.
So that puts them squarely in the infrastructure development game.
Immediately. And the third piece, which you touched on, sounds like the biggest capital generator.
The stake in AI Infrastructure Acquisition Corp.
Exactly. They hold a massive 49.5% stake in that IPO, which trades on the NYSE. That IPO, it successfully raised $120 million.
Wow.
So if you do the math on their stake, that translates to roughly $20 million in book equity for Jet.AI. And here's the crucial part. It's non-dilutive capital.
Meaning they got the cash without having to issue more of their own stock and dilute existing shareholders.
Precisely. They basically leveraged their AI brand name to help launch that SPAC, and now they get a war chest out of it to fund the new pivot. Very clever financially.
So the ambition is clear. Use whatever cash the aviation side throws off, plus the AI brand, to rapidly shift into AI infrastructure. But ambition costs money. Before we get too carried away dreaming about Canadian hyperscale campuses, let's pivot to Section 2. Are the fundamentals in their current aviation business actually strong enough to support this massive two-front strategy? Let's dig into the financials because, yeah, the story here is, like you said, a tale of two different reports. On the revenue side, things look pretty strong. They reported revenue of $14.02 million in 2024. That's up, what, 14.8% year over year from $12.21 million in 2023. So solid demand seems to be driving that top line.
But, and this is a big but, this is where the caution flags really go up. This is where the financial stress becomes obvious. While that top line is growing nicely, the company is absolutely not generating positive free cash flow right now.
Okay.
In fact, the net loss actually got a bit worse. It increased slightly to negative $13.38 million. That's about a 5.7% increase in losses compared to last year.
So growing revenue, but also growing losses. Not ideal.
Not ideal at all. And it raises the single most important question for anyone looking at this stock. How long can they keep up this high growth without hitting profitability? Especially while they're trying to pull off this incredibly capital-intensive data center pivot at the same time, these persistent net losses, the negative cash flow. It puts significant pressure on the balance sheet. And if they need to raise more capital to fund that infrastructure move, well, there's a very real, very high risk of potential equity dilution.
Which always hurts existing shareholders badly.
Always.
And we really need to emphasize this point for you, the listener. The source material made a crucial note. The specific debt figures, the exact cash positions, direct access to the 10K or 10Q filings, they weren't readily verifiable in the materials we reviewed. That's a huge hurdle for due diligence. It means you're relying heavily on what management is saying in their summaries and commentary. You absolutely must understand this adds a layer of speculation, of complexity that you just don't get with most blue chip investments.
Exactly right. That demands extra scrutiny before you commit any capital. However, just looking at the market snapshot, the stock trades with a tiny valuation, a microcap. Market cap is only $8.74 million.
Very small.
But despite that small size, the daily trading volume is actually pretty solid. Recently, over 258,000 shares changing hands daily. That suggests active trading and, importantly, decent liquidity for a microcap.
So active traders can likely get in and out without pushing the price around too much.
It helps, yeah. Better than many stocks this size.
Okay, now let's get to the exciting part, the reason people might overlook those losses, the potential upside. Because despite all the risks, there's some incredibly aggressive bullish sentiment floating around. And this is where it gets really interesting. We're seeing analyst coverage rating this stock as a strong buy with a, frankly, highly ambitious 12-month price target of $11.
$11.
Yeah. That projects an upside of, what, 310% from where it's trading now?
That is just an astronomical target. And we have to assume, right, that analyst target is entirely based on two things happening perfectly. The infrastructure pivot succeeding and that big merger closing.
Engine, yeah.
That kind of upside, it's completely reliant on executing these massive, high-stakes, speculative catalysts. It's not based on current earnings, that's for sure.
Wait a minute, though. They're trying to do both at once. A paradigm shift into building hyperscale data centers and trying to close this huge, complex aviation merger with flyExclusive. Doesn't that just split resources, split management focus? Seems like a recipe for, well, not succeeding at either. Which business gets the priority? How does an analyst justify 310% upside with that much execution risk?
That is the central tension. You've nailed it. The sources suggest the justification for that high rating is that the flyExclusive deal is seen as the immediate path to shoring up the legacy business financially. Remember, the two companies mutually extended the closing date for their asset sale merger out to December 31st, 2025. So they're reaffirming their commitment, even though there have been regulatory delays.
Okay, so what's the rationale there? Why is that deal so critical?
Simple: scale. Completing that transaction would instantly boost their fleet size, create massive cross-selling opportunities between the two customer bases, and generate significant scale efficiencies. Potentially, it could make the remaining aviation part of the business immediately more profitable, or at least less loss-making. That would relieve the pressure from those persistent losses we talked about.
And provide a more stable foundation to actually fund the AI infrastructure build-out.
That seems to be the thinking. The merger is the bridge or the safety net.
But the risk cuts both ways, surely.
Oh, absolutely. Any negative surprise, another delay, or worse, a cancellation of the flyExclusive transaction could instantly kill a huge part of that analyst optimism. It would weigh heavily on sentiment, likely sending the stock tumbling.
Classic high-stakes, event-driven speculation, then.
Textbook case.
Speaking of timing and events, let's look at the calendar. What are the immediate things we need to be watching for, the near-term catalysts?
Okay, the next big one is the Q3 earnings release. That's scheduled for November 11th, 2025. If they manage to beat estimates on revenue growth again, keep that top-line momentum going strong, that would likely trigger some bullish short-term price action.
Makes sense. What else?
Beyond earnings, we need continuous updates on two main fronts. First, the commercialization of their own AI platforms like CharterGPT or Ava. Are they actually selling it, making money from it? And second, crucially, progress reports on that Canadian hyperscale campus development with Consensus Core. Those updates are key to validating the whole strategic pivot and keeping the market interested.
Got it. Okay, let's switch gears and look at the technical picture. Section 4. Technicals, volatility, and risks. As of mid-October 2025, what are the charts telling us? The stock's been trading recently in a range between, say, $2.66 and $3.04. And the immediate trend indicator, well, it shows underperformance, which kind of fits with all the uncertainty we discussed. It's trading below its 50-day moving average, which is around $3.26, and significantly below its 200-day average at $3.93.
Yeah, technically the stock's fighting an uphill battle right now. Key support seems to be hovering near $2.30. For a really substantial technical buy signal, the kind that makes momentum traders jump in the stock needs to break decisively above that resistance range between $3.73 and $3.85.
So it needs to gain almost $1 just to get back into what looks like a positive technical trend.
Pretty much. Needs to clear that overhead resistance to suggest any kind of sustainable move higher.
But there's a little wrinkle here, isn't there? Something on the charts that complicates the purely bearish technical picture.
There is, yeah. It's interesting. While those longer-term moving averages are negative, the 3-month MCD, which is a key momentum indicator, is actually showing a current buy signal.
Huh. So underlying momentum might be building even though the price is struggling.
Exactly. It suggests that even though there's strong overhead pressure, some bullish momentum might be quietly building underneath. Could be indicating a potential reversal is brewing, and that's exactly what makes the stock attractive for, active traders looking for a turn.
And speaking of active trading, what about volatility?
The daily price volatility is running around 4% to 5%. That's not insignificant. This isn't a stock you just buy and hold and forget about in your long-term portfolio.
No set it and forget it here.
Definitely not.
Yeah.
That level of volatility means it's a trading vehicle. If you buy in the morning, you could easily be looking at a significant gain or loss by the afternoon. It demands active management, constant attention.
Okay, before we wrap up, let's just quickly reiterate the top risks based on everything the sources highlighted, just to make sure everyone listening is grounded in the realities here, especially with microcaps.
Yeah, good idea. The 3 major risks are really the pillars of this whole investment thesis, positive or negative. First, merger execution risk. That fly-exclusive deal has to close, or at least perceived to be on track to stabilize the aviation side. Huge dependency there. Second, technology adoption risk. Will their AI tools like CharterGPT and Ava actually achieve the monetization needed? Can they successfully sell that logistics software to fund their bigger ambitions? It's unproven. And third, the one we keep coming back to, those persistent net losses. They create constant balance sheet pressure and that looming risk of dilution if the AI pivot needs more cash than they currently have planned or can get from the SPAC stake.
Right. Merger, tech adoption, profitability. Got it.
Yeah.
Okay, let's try and synthesize all of this outro time.
So if we connect all these pieces back to the bigger picture, the overall investment thesis, it does remain compelling, mostly because of the potential for massive disruption. Our sources lean towards an 8-10 bullish rating overall.
An 8 out of 10.
Yeah.
Even with all those risks.
Yeah, and that's justified mainly by the rapid revenue growth they are showing, the genuinely sector-disruptive technology they're developing, and critically, that high-impact pending fly-exclusive merger. This company clearly has strong operational momentum on the top line. The big question mark isn't about demand, it's purely about management's execution on capital strategy and closing that M&A deal.
Okay, so what does this all mean for you, the listener? Where might this opportunity fit, given its dual identity and that high volatility?
Well, for tactical traders, you can definitely look to leverage the upcoming events, like we said, Q3 earnings on November 11th, and just the general suspense around the merger with that December 31st deadline kind of hanging out there. Lots of potential short-term plays. For longer-term investors, this is really about getting exposure to potential structural change right at that intersection of AI and private aviation. But that's only if you fully buy into their story, their shift towards becoming an AI infrastructure utility. You have to believe in the pivot. Right. And my final provocative thought for you to maybe chew on is about identity and correlation. The company's beta, according to the sources, is negative 0.20.
Minus 0.20.
That's unusual.
It's remarkable for a microcap. It basically means this stock barely correlates with what the broader market, like the S&P 500, is doing. So when you invest here, you are truly making a company-specific, almost isolated bet. It's not going to just ride the market tide. So the big question to leave you with is this. If Jet.AI does successfully complete the Fly exclusive asset sale and they fully commit to scaling up their AI data center ambitions, how much of its future value will come from those legacy aviation assets versus its shiny new identity as a pure-play AI infrastructure provider?
Yeah.
That dual identity, that internal battle between the old self and the potential new high-multiple self, that's the absolute central tension to watch. And frankly, it's the primary source of all this volatility we've been talking about.